Hi everybody and welcome to March 2022's edition of Ascentis TV. We've got Lee Kosnowski doing Tech Talk and Mark O'Brien's got some tax advice for you. Quite a technical episode this time, so you may have to play it back a couple of times to absorb all of the advice. Let's just jump straight into it now with Lee's Tech Talk, and he's looking at the changes to Xero.
Hi everyone and welcome to the latest episode of Tech Talk. We've recently had a Xero product update, so I thought I'd use this episode to take you through some of those key features that Xero have brought in. Let's jump into the Xero demo and take you through them now. And one of the first features that I was going to highlight is probably something you've already seen, and that's it. Xero's had a little bit of a facelift in terms of the reports section in accounting and reports here. So you'll see here right from the offset that Favourites is now appearing at the top of this screen, and you can just simply add to Favourites by clicking on the star next to it there. One of the other areas we've got is the ability to show or hide descriptions. So that just gives us a brief oversight of which report does what. But probably one of the most useful features are just here, the three little dots next to each report if it's available. And that's where you can capture the older version. So if you're a dinosaur like myself and you still use the older version, you can find that here. There's also some pre-populated reports, which are quite common there by comparing by the tracking category, month to date or year to date. There's also a brand new report here, the budget variance report. And if you click on that, you get this screen here. And this just gives a better overview of the actuals versus budgets. That also feeds into the Xero dashboard. So if you use the widget for the account watch list, you can now click on the three dots here and show the budgets column, so you can use the actual versus budget on the dashboard as well. And next, I just want to show you a very little feature within bank reconciliation, so accounting and bank accounts there. Within the bank reconciliation, there's a minor change. The ability now to have the compact view just allows us to squeeze a few more entries on there to reconcile. But secondly, there's probably an area that you may not see quite as visually, and that's the fact that Xero have come up with an enhanced algorithm on the predictions. So they've used not just your historical data, but the wider community within Xero to establish which suppliers provide which services. So hopefully in the coming future, you'll get to see a greater accuracy in the prediction of who the contact is and what the transaction's actually for. One of the other updates that Xero has been working on is within Xero Projects. Now, by reminder, Xero Projects allows us to actually track an individual event or project, generate a budget for that, and track the costings against that specific budget there. Xero Projects is actually a paid extra subscription, but you can access it from a demo point of view by just jumping into the Xero demo company, which is what I'm using here for the example. But you can access the demo company at any time by going into your organization tab here and just clicking on My Xero. Once you log on to that, you can jump into the Xero demo and not just use projects, but you can try out postings that you're not sure are going to work, or payroll if, again, you don't use that within your subscription. So the actual update itself is in a couple of areas. Within projects now, you have the ability to assign projects on a individual level. So if you click on the edit project details, you can either make the project public, so available to anyone with access to projects, or private, so you can allocate it to just one particular person. So it's sensitive and it just belongs to Fred Smith. You can click private and allocate it to that particular person. There's also a new report, which is in project financials here, and that just allows you to see all the projects and the individual costs and invoices for that. So it gives you a project and a gross profit percentage against that. One of the other areas that's probably not been highlighted previously is within the individual project itself. So you've got a little summary view of that specific project. So in this case, we've got the right agency project up in details. And this handy little profitability tab here takes you through to this screen, which gives you a great little visual of the total invoices and total costs against that specific project there. And the final announcement that Xero made in their latest product update was in the Xero Marketplace and integrations with other apps. So they talked about enhancements with Workflow Max. Within that integration, you can now merge fields that will pull in detailed information about quotes and estimated amounts, previous invoice amounts, and total claimed and unclaimed amounts, as well as the remaining balance. For Shopify, they've worked on the entire integration from scratch. It's a brand new app, basically, and in that you can now see how much revenue and profit is being made each day. It'll send the sales transactions to Xero for easy bank reconciliations and hopefully easily help you track your cash flow. They've also got an enhancement in their integration with Go Cardless. There's a new mandate matching feature which lets merchants import their active mandates so they can manually match mandates with their customers. Okay, so that's a wrap for this episode of Tech Talk. Hopefully something useful in there for you, and we'll see you in the next instalment.
Thanks, Lee. Great stuff. Certainly one for all you Xero enthusiasts. Up next, it's Mark on tax tips and his quick tip. And with the end of the financial year next week, Mark's got some steps you could put in place to mitigate your tax liabilities before the 5th of April. Over to you, Mark.
Hi, welcome to this month's tax tips. With the 5th of April fast approaching, this month we're going to look at some pre-year-end tax planning measures for individuals. The three areas for us to consider are income tax, capital gains tax, and inheritance tax. Jumping straight into the income tax side of things, the big change approaching on the 6th of April 2022 revolves around the social care levy. Now, the social care levy is going to add 1.25% to employee national insurance contributions, and it's also going to add 1.25% to employer national insurance contributions. Now, the government didn't want small business owners to miss out, and knowing that they often pay themselves a very small salary that doesn't attract any national insurance and take the vast majority of their remuneration as dividends, they've helpfully increased dividend tax rates by 1.25% as well. Now, just to recap on how the current system works, the first £12,570 of any individual's income is tax-free because of the tax-free personal allowance. Where you are taking income in the form of dividends, then the next £2,000 is also tax-free by virtue of the dividend allowance. The next £35,700 of dividend earnings are taxed at 7.5%. If you're an employee, that's the bracket in which you are paying 20% income tax. Of course, you don't get the dividend allowance if you're an employee or paying yourself through PAYE, and therefore £37,700 of your income is taxed at 20%. The next £49,730 of income is taxed at 32.5%, or if you're an employee, PAYE earner, it's at 40%. Now that takes us up to total earnings of £100,000. Once you go above £100,000, you start to lose your entitlement to the tax-free personal allowance. And that erodes at the rate of £1 for every £2 you earn above £100,000. So rather than having a new tax threshold, there is simply an effective rate of tax for earnings between £100,000 and £125,000, which on dividends is 40% and on salaried earnings is 60%. Once you've got through that tax bracket, the next £25,000 of earnings is subject to 32.5% on dividends, 40% on PAYE earnings, and that takes us up to total earnings of £150,000, above which on dividends you will pay 38.1%, and on employed PAYE earnings you'll pay 45% income tax. Now, obviously with the social care levy, these rates for dividend taxes are going to increase. So the 7.5% rate will go up to 8.75. The 32.5% rate will go up to 33.75. You get the idea. I won't go through them all. In terms of trying to mitigate that, first of all, small business owners might be saying, well, should I continue to pay myself in dividends, or would it be more tax efficient to revert to being on the payroll, paid as PAYE? Well, because of the change, not just to dividend rates, but also to national insurance, the overall effect is relatively minimal. And if it was more tax efficient for you to take dividends in this income tax year, then it still will be next year when these new rates apply. In terms of trying to mitigate the increases, the first thing to do is to consider whether it's appropriate to accelerate some dividends into this income tax year before the 5th of April 22, and pay the lower rates of dividend tax this year rather than paying something next year. That's probably something that'll apply if your earnings are currently less than £50,000 and therefore you're in the lower rates of tax. You might want to take your dividends up to the £50,000 higher rate limit to bank that 7.5% rate this year. Might also apply if you're a higher rate payer. You may want to take your earnings right up to £100,000 and bank the rates this year. But generally speaking, it's probably worth taking some advice before committing to accelerating any dividends. Other things you could consider, personal pension contributions would extend the thresholds at which higher rates of tax apply. So at the moment, as we said, once your earnings go above £50,000, you start to pay the higher rates of tax. And once you go above £150,000, you start to pay the top rate of tax. If you made a personal pension contribution, let's say £10,000, then you get tax relief putting that money into your pension. So you put £10,000 into your pension, the government tops it up with a 20% tax relief, and therefore £12,000 is credited to your pension. Well, the thresholds that you pay tax at are therefore increased by that £12,000, and so the £50,000 threshold suddenly becomes £62,000, which may be helpful going forwards. You can also consider making gift aid payments if you're feeling particularly charitable at the moment. Gift aid payments work in exactly the same way as pension contributions. So if you made a £10,000 gift to charity and it qualified for gift aid, the charity get £12,000 and your basic rate band threshold again is moved from £50,000 to £62,000. Moving on from income tax, the capital gains tax annual allowance, everybody receives £12,300 allowance. If you crystallise any capital gains within an income tax year that are £12,300 or less, then no capital gains tax applies. This is a use it or lose it allowance. So if you don't use the allowance this year, it doesn't roll forwards. You get the same allowance again next year, but it's still only £12,300. So how do you take advantage of it? Well, it's quite difficult. Obviously, if you haven't got anything to sell, then there's not much you can do. But for individuals with share investment portfolios that are pregnant with quite a lot of gains, you might want to consider crystallizing some of those gains within the portfolio. You could sell some of your shares and within various time restrictions, potentially buy them back. You do have to wait more than 30 days to buy them back. Otherwise, some anti-avoidance legislation kicks in and stops you crystallizing the gain. But otherwise, you might want to consider selling some of your stocks to realise those gains now and use up your allowances. For investors, those of you who invest into ISAs, there's an annual investment allowance of £20,000. You can only put 20 grand a year, put £20,000 a year into an ISA. If you've maximised that, or if you like to maximise that every year and you haven't yet done so, best to do that before the 5th of April. If you're investing in ISAs for your children, then the maximum you can invest per child in any given tax year is £9,000. Again, worth looking at that and deciding whether you want to max that out this year. Moving on to inheritance tax, there is an annual gift allowance of £3,000. That's in total per donor. So if you're looking to give cash to your family, then overall you can give £3,000 a year, and that immediately comes outside of your estate for inheritance tax purposes. Again, that is something of a use it or lose it allowance. You can't accumulate the £3,000 allowances forever. They do allow you to roll forward 1 year's allowance. So if you didn't do it last year, you could potentially put £6,000 of gifts together this year and give them to the lucky beneficiaries now. But otherwise, if you don't do that, you will start to lose them. There's the small gift allowance. Now, this is unlimited per person, so you can give a £250 gift or up to £250 of gifts to as many individuals as you wish. And finally, for inheritance tax purposes, there is the regular gifts out of income opportunity. This is a bit of a more complex area, so again, it might need advice and planning if you want to implement it. But fundamentally, if you are in a virtuous position where you have income that exceeds your outgoings and therefore you are accumulating wealth, perhaps in your retirement or close to retirement, you can consider gifting part of that income that is simply accumulating in your bank account to members of your family. And if they are regular gifts out of excess income, then they immediately fall outside of your estate for inheritance tax purposes. So this month's quick tax tip applies to business owners and is focused on company mobile phones. We come across quite a lot of confusion in this area, in that often employees or business owners have their own personal mobile phone and want to bill the cost of that to the company. Now, there's two very contrasting tax effects of doing that. The first is if a company takes a contract for a mobile phone and gives it to an employee or a director, then there's no taxable benefit arising on that occurrence. The individual concerned can use the phone privately and for business use. You don't need to monitor the amount of private use. There's no taxable benefit and everything's fine. The company gets a corporation tax deduction for the cost of the mobile phone. If the director or employee has their own mobile phone and is trying to pass the cost back to the business, then the business can't simply meet the mobile phone bill, or if it does, an income tax benefit will arise. What should happen in that case is that the employee must get an itemized bill, highlight all of the calls that relate to business, and only claim for those calls. Now, as you can imagine, that will be a very onerous task. Not very many people want to do it, and it's a bit of an area that can trip you up in the event of a Hmrc inspection. So it's always best, and our advice, to make sure that company mobile phone contracts are taken out and mobile phones are provided to employees to cut down on the bureaucracy of having to assess bills and also to avoid any income tax pitfalls.
Well done, Mark. Lots of advice there, guys, and still plenty of time to get those tax planning measures put in place before the 5th of April next week. Right, it's time for AdminMin with Lee.
Hi everyone. As usual, we've got all those key deadlines for you up on screen, including that 5th of April tax year end. So hopefully you've got all your affairs in place ready for that. Elsewhere, we've got a new advisory mileage rate recommendation from Hmrc. I wouldn't get too excited, I'm afraid. There's been very little change in that, and it certainly doesn't reflect the recent price increase we've had in fuel. Towards the end of the month, we're starting to see a reduction or cessation of the COVID support that's recently been granted. In three areas, really. We've got the end of the SSP reclaim, so we could actually get money back for those people that were off with COVID. That ends. We're not able to reclaim anything there. Instead, it's covered by the employer's allowance that's been granted. We've also got this ending of the 66% kind of business rate scheme that was in place. That stops on the 31st of March. And probably the biggest one of all is the end of the reduced rate hospitality VAT. That's going from 12.5% back up to the standard rate of 20% in that sector. At the end of June, we've also got the end of the recovery loan scheme application. So that's something maybe you need to consider if you're still wanting to make use of that. And sandwiched in between all that, we've also got an increase in the national minimum wage that goes up on the 1st of April. And we've got this new national insurance charge as well. So the extra 1.25% kicks in on the 1st of April. That's it for this episode, and hopefully we'll see you soon.
Okay, thanks, Lee. Right, guys, you're all up to date. End of the financial year next week. So get your tax planning done. Take particular note of the end of the last bits of COVID support from the government. It's the end of the show. We'll see you next month. Bye for now.